everyone for joining us, especially in the middle of the summer. We're excited to have this summer special webinar. As you know, the market just keeps moving around, but I can say one thing that has been a constant is the non-agency market continues to be strong. The products continue to gain more momentum, and it really has evolved from a nice to have set of products to a have to have product. We're also finding that a lot of IMBs are new to the space. And so I'm really excited about today's panel because we're going to talk about how to be successful, what to look for, how to navigate these programs, and why these programs are so important, along with, good partners and good tools. So with that, I'm really excited to introduce our guest panel. First, we have Taylor Gosney, who is with SG Capital, Director of Client Development. And she has spent the past 6 years helping shape SG's correspondent lending channel and market presence, and brings over 20 years experience in the mortgage industry. And I have to say, we've worked together for a long time, and I'm really excited to have you join our as one of the guest speakers on our panel.
Thank you for having me.
Yes. And Aaron Samples is, I'm hoping, able to join. He's running a little bit late. Aaron Samples is the COO of Logan Finance and brings over 25 years experience in the mortgage industry. And I'm hoping he's able to join us. We're going to carry on either way, but if he pops in, I'm excited to have him join us as well. And Raj, my partner in crime, SVP Development for LoanNEX. He's been with LoanNEX for over 3 years and brings over 30 years experience in the non-agency space, as well as a lot of experience with enterprise platforms in this space. So welcome, Raj.
Thank you.
So first, I'm going to make sure that you guys can see my screen, the presentation that's up. Okay. So as you guys know, for regulars on our webinars, we're going to go through some information about the market, and we're going to walk through some of the information that's going on in the market, some of the key trends, and bounce through some of those things. But we've got a particular focus today on how DSCR is doing and why it's doing so well, why it's such an important part of the market. But first, just looking at the market in general. As I said in my opening remarks, the market has been moving around quite a bit. And with interest rates not coming down as much as originally projected by the MBA, we're also seeing some declines in the projections for total volume, not only in 25. I think the original projections were at about a 16% growth. So they've come down a little bit in 25, but they've also come down in 26 from almost 14% down to 10% growth. I'll point out that the purchase volume is projected to stay pretty constant. So that is really an adjustment more than anything in that refi projection. So we're not seeing an expectation of a material rate drop in the near term. And that continues to play into why these products are so important, how these options are important, how paying attention to market blips are important, because that's when the refi activity really pops in. But on the right side of the page, that's the non-agency securitization. And with rates are where they are, a lot of new entrants are coming in. And I know that's not necessarily what SG or Taylor loves to hear, but it's an important part of the dynamics about what's going on in the market, because with rates are where they are, there's a lot of institutional and portfolio interest in these products. So it is changing the landscape, and it's changing the product scope, and it's changing how people are accessing these products. But more importantly, it's making it, again, a have to have, not a nice to have for originators. So Taylor, with all these changes that are going on in the market, I'd love to get some of your perspective on how to think about all this.
Yeah, absolutely. And, competition is always healthy, right? We don't want to be the only one in the game, because then that makes our product much less acceptable in these types of situations with securitizations. We are definitely seeing securitization issuance up. We're looking at about 20% for the non-agency space, and it's up even more in the non-QM space. So, and that is because of the acceptance. That's because, it's a little bit more saturated than it was, pre-COVID. But, we think that's great. We like to have the competition. It keeps us on our toes as well. So, that's always good too. Yeah, we're excited for the outlook of the rest of the year. We've got big plans to grow as well. Definitely into 2026 too. So
Yeah, and what it also does, people talk about what happened in 2020 and certain blips in the market, and this is a great sign that
mhm,
liquidity is strong and
absolutely.
are strong. All these things make it that much easier for originators to have confidence in what they're pricing, what they're delivering. All these pieces are just strengthening this part of the market. And as I flip to the next slide, we're seeing that yield curve move around a bit. And that's just a sign of some of the things that are going on in the market. But the green line and the purple line are June and July. And that's showing that there really hasn't been a material amount of rate change, at least those two, month points. And everybody knows in April, the market went a little bit crazy. So the rates are not changing that much, but when you look on the right side of the page, that shows week intervals instead of month month intervals, and we are seeing a little bit of a rate increase in the 30-year, and also a little bit of a credit spread change between DSCR and what that's the LoanNEX index for that gold program. And that is showing us that, I'll take a quick pause, and Paul Jones, the substitute for Aaron, I really appreciate it. So Paul, welcome to the webinar. Thank you for stepping in. I know Aaron had a conflict and wasn't able to make it, but
no, thank you. Thank you,
welcome,
Alex.
welcome. I'm going to keep going. You're an old hand at this. You've done our webinars before, so we're talking about some of the market rates right now.
Sure thing.
So what we're seeing is that compression in DSCR to agency is a reflection of that strong market appetite for that product. So it's resulting in a little bit of a credit, a compression in rates between agency and the DSCR products. So we're going to talk a lot about those DSCR products, but that is a really significant change. When you look over a year ago, DSCR was trading wider than the gold. And these are indexes of all the correspondent investors on the LoanNEX platform. So this is showing how the market rates are adjusting. And Taylor, maybe you can give us some insights on how SG is seeing some of this. And I'll flip it over to you, Paul. I know we're catching you a little bit off guard, but we'll see you next.
Yeah, no, I went back and did a little bit of research after our kind of discovery call the other day, and yeah, we're seeing the same thing. Just a few years back, we saw DSCR, higher than the consumer non-QM product, and now we're kind of seeing that, flip a little bit, which is great. I think, the acceptance of bank statement and other type of non-QM product offering has become a little bit more widespread. I think a lot of people were just getting into non-QM via the DSCR kind of outlet maybe, and now there's some more acceptance across all of it. But there's a lot of really great growth there, but we are seeing that. I think right now our average coupon runs around 7.5, 7.25, 7.5. So that does match the trends that we're seeing with the clients across the board.
Yeah. And Paul, are you seeing some of these same trends too? I mean, the increased demand, I would say, for the paper and the constant supply of the loan interest is sort of where we're seeing driving some of this compression.
Yeah, definitely. I think particularly with the investor market, they're not in the same position as someone looking for an agency loan in the first place, and they're looking at rates a little differently. They know the value of their money and what they can get out of an investment property from a DSCR standpoint. They know the property appreciation or values are there, and they're looking at this as a true asset to grow a portfolio or to enter into being an investor. So they're just not as resistant to that. And then I think what kind of comes with that is a lot of these entrepreneurial types of individuals end up, looking at the other product opportunities, or the loan officers present other opportunities to them, maybe for a primary residence if they're self-employed, maybe if they're looking at, a high net worth individual using asset utilization products. I think it just, again, you kind of use the DSCR as a way to get in the door, and don't fear the resistance because of rates or other complications. You tend to get a lot of other opportunity out of it from that product. But the investors are definitely leveraging, particularly a lot more cash out as well. You're seeing a lot of cash out come through.
A lot of cash out. We're seeing some of that, a lot of that as well.
Yeah.
And just for a second, and we're going to flip to the stats on what the volumes are looking like, but want to talk a little bit about silver. And silver is just, little higher LTV, little lower FICO, and that's been remaining at about a 75 basis point spread to the gold. And I don't know if you guys are seeing a tightening of the credit box, or, more of it just being a pricing adjustment. But, the volume tends to be in a pretty prime, or, a gold kind, and most of the volumes in a pretty high credit quality kind of box. But, there are, strong products that, are available for higher LTV or lower FICO kinds of borrowers. I'll throw it to you, Paul, first on that one, if you see what the product demand is on that side of the credit spectrum.
Yeah, I mean, I don't see too much tightening overall. I do see, certain attributes actually expanding. We've actually been able to expand our LTVs a little bit and open up the box in certain areas across our landscape. Again, it depends on different investors and their appetites. So we've been, kind of fortunate in that regard more recently. Obviously due to performance and the demand. But yeah, that's kind of where we're at right now. And
Taylor, what are you seeing?
Same thing, we're coming out with a guideline update the next couple of weeks as well that does expand, LTVs, product offerings. We're going to be coming out with a 30% option for expense factor, a fixed expense factor. So we're just seeing that the market is accepting these things more. We have a lot more data now that we've got a couple of years of true data, performance from a payment standpoint, but also just kind of data on the types of borrowers and the profiles. So it's really helping us to expand, and the credit team is really on top of trying to keep our guidelines fresh. We probably do 2 or 3, big guideline releases a year, and that's all based on data, performance, things like that.
So Taylor, I have a quick question. With the widening of these programs, do you still see the appetite for the securitizations to be just as strong? I mean, because it has been pretty strong over the last few months. You can see, I mean, in the previous chart that it was increasing, but these programs, are they going to make is the appetite still going to be just as strong for these programs in a securitization?
Yes, I very much think so. I think especially, Paul was mentioning that they have, increased their LTVs, and we talked about, competition, and competition is good for these things. This is why we want that. We want lots of buy-in on the product. So, if there's a shift and we're the only ones offering these types of LTVs, then maybe that's where, for us, it would be a problem to do securitizations.
Right.
But, when there's wide acceptance across the industry and the market for that kind of stuff, I don't see that it being an issue.
That's great.
And I think we're pricing for some of that risk when we started moving into the higher LTV areas, or where some of the other buckets where there's some improvement or opportunity for the borrower, for the consumer. But to Taylor's point, yeah, you don't want to be the outlier, right? You don't want to be kind of too far ahead of the curve. But since I've been in non-QM, I've always believed that, the competition breeds the success of the platform itself or the product itself, because, everyone's kind of in a similar place, and maybe there's a few little differences in terms of your soft guidelines here and there, your appetite around certain exceptions. Then generally speaking, we all benefit from that competition.
Yeah.
Yeah, and so what I've got up on the chart here is, I'll focus on the right side for a second, that over 80% LTV, and that's mirroring what you guys are saying. So that we saw in the second quarter, it's only a 1% increase, but it still is an increase on that over 80% LTV. So it's interesting. It's probably coming in a very tight, kind of package, but it's also that data, the strength of the market, the strength of the securitization market, the understanding of what these products are. This is all, really positive things for the market. So I'm going to flip to the left side. We saw volume pretty flat during May and June, but we actually saw lock volume up. So I think that means that people are actively engaged in the market, but they know they have a deal and they're getting that deal done. So and I know Taylor, we spoke about this a bit before this webinar. So tell us a little bit about what you're tracking and what you're seeing.
Yeah, locks are definitely up for us too. I mean, typically summer months are a little bit more busy just in general, but we're definitely seeing a large increase, and we are adding more clients and things like that along the way. But we're just seeing that the break between product, so things like bank statement, we're seeing definitely an uptick in close-end seconds, bank statement product, things like that. Again, I think we're in the prime of non-QM at the moment. I think, it took a while after COVID to kind of get everybody back into the saddle with things. So I think now this was the year to really kind of get full buy-in from a lot of people. So we're definitely seeing a lot more of that. Some of the stats that you have here, very, very relatable to what we're seeing on our side too, as far as product mixes, LTVs, things like that. So nothing really, out of the box specifically on that kind of stuff.
Yeah,
What's
Paul.
interesting is that the bank statement volume has gone up considerably since the last quarter. And what do you attribute that to? We've seen it's been flat over in 2024. We saw it kind of flat, and then all of a sudden, the last quarter of 2024 and into 2025, we saw an increase in there. I know there are a lot more borrowers. I think the current estimate is like there's 60 million, self-employed or 1099 workers out there. So there's a large pool. 10% of the working population is like self-employed now, they're saying. That's a significant pool to go after. Are both of you guys targeting that group? I know it was that way back in 2016, 2018, when non-QM was on the growth path there. Everybody was focusing on the gig worker or the self-employed borrower. But is that focus shifting now?
I would say so, Raj. I think one of the things that we've continued to do is to try to drive the awareness around non-QM, and I believe Taylor would say the same thing. We continue to introduce these products to loan officers who have never tried them before, and it's just continued to kind of chum the waters with new loan officers who are reaching more of those particular borrowers. And as the self-employed borrower increases year over year, they're just gravitating towards the two most naturalistic products in non-QM, right? DSCR, I always say you can go after that immediately, right? You can leave a training today and go and find a real estate investor anywhere you look. The self-employed borrower is not that much harder to find, but they come through the door no matter what. So I think if you continue to indoctrinate the loan officers with understanding bank statements, you take a lot of the friction out of the product with your resources, whether you're running your bank statement analysis up front. You're making it easier for that loan officer. So they're going to tie themselves to the two products that are best supported for them and have the easiest opportunity for them. And I think that's what we're seeing. It's just, every day it's a new loan officer or someone who hasn't tried non-QM in quite some time, and they're just gravitating towards the biggest products.
Yeah, and in the first quarter, we saw an anomaly, and that anomaly was a pop in full doc, and a pop, you can see at the bottom of the page, in average loan size. And I think that was because there was a rate, adjustment that resulted in a lot of jumbo refis, as well as a lot of the purchase volume that sort of was pent up from the fourth quarter, came through. So it was an interesting first quarter because we had a pop of change, and that's really what brought some of the other percentages down, is because there was just so much full doc refi activity happening. that is, the best information I have been able to come up with. I'm sort of curious. It's a little bit of, last quarter versus this quarter. But I think this quarter is really a return to some of those same kind of mix that we had before. And you can see it's a return to that same average loan size and things like that. So I think that first quarter had just a little bit of pull from that, rate divergence in the early part of the year.
Right. Yeah. No, I would definitely, I shadow what Paul was saying too. I think the other thing that has been obviously a big point of topic is software, AI, development of these types of things, the OCR for bank statements where people, can read the bank statements and, put out some information for you. That's definitely been a huge topic of conversation. Programs and systems like LoanNEX that help with eligibility and pricing and tools that are now available to people to take a lot of the guesswork out of it has really helped drive it. And from a full doc perspective, I mean, I don't really know. I didn't look too much into that, but whenever I talk to someone about a full doc option, there's always some other characteristic that's obviously driving it. So non-warrantable condos is kind of big thing, topic of conversation. So I wonder, and I didn't look this up, but I wonder if there's some sort of correlation to property, condo, something like that, that's kind of driving the full doc. Loan amounts, you can go non-agency with a lot of that, versus non-QM. So there's got to be something about the transaction that's driving it to non-QM specifically. And that's kind of, I've seen a little bit of that just in some scenarios coming through, a lot more property driven things like that I think are impacting the loans coming through.
Yeah, I think that's spot on there, Taylor, for sure. Yeah, I would agree.
So before we flip, just to give you a heads up, Raj, before we flip into, we're going to do a quick demo of like, how is it best to navigate through these DSCR products? And I know we just were talking about bank statements, and there is a question on bank statements from the audience. So it says, without promoting any specific technology, what are the most frequently used advanced tech vendors for bank statement analysis? Using humans to do all this is very difficult. So a couple of things, do you recommend any for originators to use, or maybe you can talk about what you have also within your own platform for them to navigate? Paul, you want me to start with you?
Yeah, I don't want to over promote anyone specifically. I mean, I can say who we use, of course. I mean, we use Prudent AI. There's a few other major providers out there as well. The key thing with the technology platform for running a bank statement loan is, the speed, obviously accuracy, and complete transparency, right? So I think anyone that you're going to be using for this element of non-QM, you want to make sure you can get that benefit up front, right? You don't have to wait to get it calculated, and then you can kind of see behind the scenes what is driving that final income that's being used, because someone's got to explain that to a borrower. Someone's got to work through it with an underwriter, explain large deposits and understand things there. So I think whoever you're really partnering with should have something that's very clean and user friendly, and that's sometimes not the case with some of the providers out there. But the user friendly element is key, and if it allows even a loan officer and originator to go in and run that analysis themselves, that's an even bigger win, that they can just do the work without waiting for an analysis from someone else.
Yeah, and Taylor, I know you guys are launching a new service as well, so you might have some insights on this.
Yeah, I mean, definitely. So I'm on part of a committee. So we're partnered with Laminar. That's who we use. And, in part of all of this discovery, and exactly to Paul's point, is that it has to be about ease of use. We want to get, the less that somebody has to do in order to get to that place where income is always the most daunting part of it, right? You got to get that right. Even with a DSCR loan, even though there's no income, you've got to get the DSCR right. Like that has to be spot on. You've got to make sure that you are honed in on any sort of, income analysis. So, there was always, Excel spreadsheet calculators and stuff like that. So there was always something like that available, but really with this OCR type of technology where it's reading and it's determining eligibility of the deposits, that takes even more of the guesswork out for our clients, for the loan agents, and putting it back in their hands, right? So now they can kind of control it. A lot of times I think loan agents were nervous about it, so they would just send the file in and then get it underwritten, and then all of a sudden have to deal with, whatever the underwriter determined for the income. You really need to know up front. Like, you really do need to know what your DTI is, what income we're working with from an eligibility standpoint, but certainly from, a lending standpoint, a financing standpoint. How much can you get out of this loan by utilizing a bank statement program versus an agency type product? So it's really just kind of deciphering between those two. And as quick as you can do an AUS and run something through DU and LP, you can do that with these types of technologies, Prudent AI, Laminar, and the like. So I think this is their year for it. I think we'll start to see a bigger shift and more offering it, but not only offering it, accepting it. So we're actually injecting that into our guidelines about, AI type of, loan software for income calculation. So we're actually putting logic in there, so people know that they can kind of run with it. They know it's kind of a guaranteed acceptance of that income.
I'm loving that. It's exciting. It really is. And, we're looking at partnering with our partners as well on this, because it ends up needing to be navigated through your rules as well. So I'm going to, we talked a little bit in the front, and one of the things we wanted to highlight during this webinar is, DSCR is a big portion of the market. Those investment property loans are really significant, and navigating them and understanding them. We were going to use an example and let you guys talk about, not necessarily, obviously we love our tool and our tool is the best for doing all of this, but this is also about how do you talk to this audience about navigating these loans and delivering these loans. So I'm going to flip it over to Raj, and you're going to open up the system and, talk about how to best navigate these programs.
Yeah, absolutely. So I'm logged in or I'm going to be logging in as a seller would. Can you guys see my screen yet? Is it?
Yep.
The sharing? Okay, yeah, great. Okay, so I'm going to sign in. Going to go the easy route. I've already saved a scenario in my pipeline, so I'll bring that up. You'll notice that I put in a 5-year prepay here, and I have 2 ways to price it, right? I could price it on the stated DSCR, or I could have our system calculated. I'll do the qualified way, so I could calculate the DSCR. And you'll notice that these 5% options come up. Now, Taylor, you wanted to speak specifically to some of the things that you guys do in our system that's different than what Logan may do in our system. You guys really heavily lean on our eligibility Q&A. So as a seller comes in, wants to really understand whether that borrower or this scenario qualifies for a loan, you make them go through this list of questions that are taken out of your soft guides. Logan takes a different approach. They have a shorter list of questions. They want to reduce the speed bumps, get the loan over to them. But how has this helped you guys in helping? I mean, how has this part helped SG in understanding whether that loan qualifies when it's finally delivered to them?
Yeah, what we tried to do with this Q&A eligibility section is obviously, like you said, pull out some of the soft guidelines. So things that aren't necessarily part of the hard matrix, or that would impact pricing. We tried to really pull out things that could impact eligibility. We would hate for somebody to go through the process and all of a sudden realize that, the acreage was too high, or that they were a first-time investor and they were limited in their, FICO or LTV or product or whatever it was. So we really tried to make it as comprehensive as possible. But also what we tried to do is highlight some of the niches that we have with our product offering, like being able to use a primary wage earner's FICO to qualify. That's something that most systems, I don't think any systems really take advantage of. So things like, prompting you and reminding you of some of these things. Hey, don't forget you can use a primary wage earner's FICO to qualify, because that can impact eligibility and pricing. So there's lots of things that we tried to kind of build in. I know it is lengthy. But realistically, it's going to not just get you the most out of your eligibility, but it could actually impact your eligibility as a whole by being able to utilize some of the niches that we have.
Much easier than going through matrices and, you know,
Right.
the paper guidelines, you know, so
Right.
yeah.
And if you hit best per for a second, what you're able to do in LoanNEX by hitting that best per investor is it's going to say how much is the best per investor without necessarily each program per investor. So now you can see across these programs without having to dig into all the different versions within a program. So it's still showing you that, but those questionnaires, that also tells you, just like Taylor just said, what's important about this investor's programs that I need to know about. So when we're talking about how do you navigate these DSCR programs, this is really a great way for you to sort of know what you need to ask and know what you need to do. So you can open up Logan's. Logan does have a little bit of a different philosophy. You know, they're going to have much fewer questions, but they're still important questions about these programs that you need to know. So this is a great tool as you're navigating these DSCR products for understanding, you know, what that core eligibility is, but then also what more do I need to know?
And keep in mind that I did margin adjust all of this pricing. So the pricing that you guys are seeing on this is not necessarily what Logan or SG offers. I would recommend that you reach out to them to get approved with them if you're not. But I did that margin adjustment, so we're not showing raw pricing on in this demo.
Thanks, Raj.
Yeah.
Yeah, and so Paul, you know, you obviously do a lot of this every day when you're doing training for folks too. What suggestions do you have about navigating these programs? Feel free to lead them through a LoanNEX piece of that too. But what tools do you recommend to navigate these?
Yeah, I mean, I definitely recommend LoanNEX, whether you have to go through a long list of questions or not. It just, the key thing is to ask your questions up front, understand the fundamentals of the product, of course, and that, you know, DSCR is going to have different eligibility requirements based on the nature of the product, right? So just understanding it, first of all. Secondly, you know, when you're dealing with a lot of these investors, you know, you have to be really able to talk the talk through, you know, gift requirements and, you know, title requirements are a little bit different. You know, some of these borrowers are taking cash out of several properties to buy another property, understanding the reserve requirements, things like that aren't transparent just in the surface of looking at, do I have the right DSCR? You know, do I have, you know, am I doing a short-term rental property versus a traditional property? So I think a lot of it is, you know, getting into the eligibility tools like this and extracting as much as you possibly can early on. The last thing you want with these loans, especially when you might have 2 or 3 loans on the line, referral relationships that you're just building with these products, the last thing you need are surprises because you didn't do a little bit of extra homework up front. And I think LoanNEX is just a great tool to do a lot of the homework, or it does a lot of homework for you, really. You know, it does allow you to just nip all the challenges in the bud.
Yeah, I'm going to keep it short and sweet. Otherwise, I'm going to hand it back over to you so we can continue.
Great. Well, consistent with what we were just talking about, this shows that breakdown for purchase versus refi. And there is a big difference. We talked on earlier in the webinar on the cash out refi components of especially DSCR products or investment properties, I should say, as people are trying to access their equity to get into the next deal. So those cash out refis drive a lot of the refi side of the market. And you can see a large portion of that is DSCR. And what's interesting, you can also see in that first quarter blip, you know, what we talked about, that blip coming in of some of that refi activity taking place. But in general, on a purchase side, we've got a pretty consistent blend with DSCR representing about mid-40s of the mix. But on that refi side, that's a big area of just what we just talked about. How do you qualify? How do you reach out? How do you get there? Though that's showing you that volume is pretty significantly DSCR heavy. I didn't know if you guys wanted to talk about, what you're seeing in that refi versus purchase trend. Taylor, I'll start with you. We've been talking a lot about those DSCR products, which I think are super important, but if we flip to the purchase side for a second, it's a little bit more even, a little bit more diverse in income doc types. So this may or may not be what you guys are experiencing, but I'd love to hear your thoughts.
Yeah, it's pretty on par with what we're seeing. So we're seeing very similar kind of trending with this. As I mentioned, DSCR has kind of flipped its head a little bit. So we're a little less heavy in DSCR and much more heavy in bank statement. That I feel like once every 3 to 4 months, that switches a little bit. But for the most part, as of right now, we're seeing very similar trends with this.
Yeah, I would agree there too. Just right there, right down the middle of the fairway, what you guys are showing there. I think there's some elements of products that kind of continue to creep up and not have a significant impact to overall, landscape of what we're doing. Your P&L products, I think the full doc to Taylor's point earlier is probably your non-convertible condos falling in there. We're seeing a lot of business cases for people to go out and kind of start marketing to those projects. And that could just be a standard borrower who just has a property or a unique property like a condotel or something that falls into some of these other realms, if you will. But yeah, that's pretty spot on.
Yeah, I appreciate you raising the P&L because we're seeing a lot of P&L plus bank statement. People are trying to say, yes, we like the P&L, but we need to see the bank statement, or they're mixing it with assets and seeing a little bit of cross collateralization opportunities in here. So there's a lot of nuances that are coming through. Yeah. And I'm just going to say, and I'll flip to this as we move to how people, can be not intimidated by all these changes. So we're talking about a lot of changes and nuances that come through, and change is hard because if you're a loan officer and you just got trained on this, or you've done a couple of loans, but these elements keep changing, it can be intimidating. I will say that's been LoanNEX's point the whole time, is to make it not intimidating, but you guys live this, and Taylor, I'll start with you again. These are some, broad-based tips, but talk to the, audience about how do you see it best to either start or expand instead of it being, something we offer, but I only have 1 or 2 people that really know how to do it. How do you really become successful with these products?
I mean, I've seen that with a lot of clients. We've had clients who have been with us for years, even pre-COVID, and they're large clients. They have hundreds of loan agents, and they themselves just could not figure out, like, why is non-QM not taking off? We have all of the product offerings, we have all of this going for us. We've lowered our margin, we've done everything we can. And really what it came down to, which was, I have a couple of clients where I advise this, and well, you need somebody in-house that is a subject matter expert. You need to have somebody embedded in your operations team that knows non-QM, someone from an operations and or even a sales perspective, right? Once you give, Paul and I do this all the time. We're training, we're trying to get the word out there, we're promoting, we're telling you exactly how to do these things so that it doesn't become daunting. But until you do one yourself, you need to kind of have someone help navigate you through it. And we understand that. So I think, having a subject matter expert, and then from kind of a process standpoint, I don't know if there's any C-suites on the call, but sometimes your process that you've built, whether it's from an underwriting, locking, and then even from a post-close diligence perspective, you really need a partner that's going to help guide you through that. You don't want to change your processes. They're there, they are what they are. It would take, moving mountains to change an entire infrastructure on how you deliver loans, how you accept loans. So partnering with someone that understands that and can be nimble with the acceptance of things like collateral and, who your subservicer is, and all of that kind of starts to get muddy. So knowing that up front, knowing that your non-QM partners can definitely help you with that kind of stuff, I think is a huge part of it from kind of a back end. I think a lot of times loan agents would probably say, yes, please give me all the products that you can give me. But then you get to the operations side and then they go, well, listen, we don't necessarily have an underwriter for it. So that means we might have to look at a non-del option or a pre-close option. We don't have the infrastructure built from a locking perspective. Well, great, let's make an introduction to LoanNEX because they can help you with that stuff. We can really help the clients get that stuff done. I mean, from a product standpoint, I think for the most part, give or take 10%, we all non-QM lenders have the same offering. So, pricing obviously can come and go. Product is pretty much the same. The core philosophy behind how you qualify a bank statement borrower and a DSCR borrower is going to be the same across the board. So knowing that, partnering with the right people, as much as I hate to say it, having a couple different lenders in your pocket, you don't want to be beholden to just one if there was something to happen. So partnering with an SG and a Logan and, and a couple others, it's always great. We always like to see more wallet share than, sometimes we get, but I think it is smart from that perspective. And that goes to the competition as well that we keep, coming back to. It's healthy. It's what helps keep the risk down from your standpoint as well, from, from a operation product execution standpoint. So I think those are some of the ways that really kind of help drive that education. We talk about all the time. Yes, you need to know about it. We're there to help. We can definitely train your loan agents, but having that internal person that is there to help is huge. And then knowing the processes and how your partner in the non-QM space can help you navigate those.
Yeah, Taylor, I know you wrote an article on NMP recently, kind of laying that stuff out. And I had the good fortune of joining Paul in a Dallas event that they had here, and they do a really good job of educating. Maybe, Paul, you could talk about some of the things that you guys do to help originators really understand non-QM, because I really enjoyed sitting there and listening to you kind of educate that group.
Oh, thank you, Raj. I appreciate that. I would say, the more you go out to the non-QM world with the idea that you're actually chasing the product versus trying to find the accidental loan, that's where people struggle, right? I mean, someone might do their first non-QM loan or the occasional loan because it's fallen in their lap. We try to develop a lot of tactics, arm in arm with our partners, to go out and find the borrowers that fit these products best, so that it's less friction from the start, right? I think it all goes back to the start of your relationship with your partner too. How you onboard, right? Originators, we all go out and educate them, but Taylor made some points around operations. I think sitting down strategically and looking at how they already work as a company and understanding that, you're sliding something in that they're not as familiar with necessarily, aren't doing a lot in, and we're expecting them to scale. So we try to have onboarding calls, not just one, maybe two initially with a new customer, but we're going back to our customers now and doing a lot of like re-education and, touch point calls with them to get an idea of their experience. Shameless plug to our brand here, but really not helping them understand, understand what they're going through and what they need more of. And sometimes people suffer in silence, and, we want to get all the loans in the door. We want to bring all these loans in, but how are we affecting change within that organization without disrupting their rest of their business, right? And trying to understand that. So that's really important. But materially, it's being, a partner in terms of just helping them find the right loans that will actually make everyone's lives easier as we go through the rest of the transaction, right? If you keep trying to fix broken loans with non-QM, it can be a real nightmare for everyone. So I think that's part of it. And we get out and do lunch and learns with their real estate partners. That we've gotten a lot of requests for that, more than ever. And if that's a loyal partner, we want to make sure we're really supporting them with white label, presentations and the like. And now we're moving into a lot of video content as well. Videos are really starting to ring a bell. So that's kind of where we are at this point. Just making sure we're connected not only with the origination side, but the operations as well on a regular basis.
I love that you guys are talking about the operation side and having more than one partner. And I'll tell you, we didn't spend enough time on the demo to show all this. Happy to do it another time with anybody that wants a demo. But what you're going to find is you may make small nuanced changes in your programs, your LTV change, your prepayment change, your income duct type that you're trying to qualify for between bank statement and DSCR. Any of these little changes, you're going to see your partners flip-flop between who's on top and who's next. So having that coverage is really how you're going to best serve your borrowers. So you don't have to be an expert in everybody's programs, because that's going to be almost too tall. That's daunting. But having a tool, first of all, having good partners so that you can turn to them for anything, but having a tool to also help you navigate through those is really all you need. And those are different tools than your agency tools. So, those are the things that are important. We hear from people all the time that, well, I've done non-QM, it's about 5% of my business. And then we're touching base back with them. Well, it's actually going to be more like 15 to 20% of our business this year. Those are common stories because, people are trying to make sure they've got a lot of throughput on their operations. And that may mean they're getting, different kinds of products through. And as you get different kinds of products through, you need different partnerships, and you need to know how to leverage them and how to navigate those programs. So these are exciting times, but this does require a bit of change. So that's what's great. I'm gonna I cannot believe we're already almost 50 minutes into this. This has been a great session, and I really, really appreciate it. But I want to give each of you a chance. You've had times to pepper in about your organizations, but really want to make sure you have a chance to talk about your program. So Taylor, I'm going to start with you, and then we'll go to Logan.
Yeah, so what I wanted to do with this slide, obviously, LoanNEX is the pricing and eligibility engine. So I wanted to kind of tie that back into how this pricing engine and how our guidelines mix together to kind of get you the most and the best out of a transaction. So specifically with DSCR, here's like top 4 ways that you can navigate to get the most out of your pricing. Obviously, we talked about it. Adding that prepay on there is going to be huge. Obviously, if it's in a state that allows it, so there are some, nuances to it. But for us, that 5% flat prepay structure for at least a 3 or more year term is going to get you the most and best pricing. Utilizing the guidelines to get your DSCR as high as you can. The higher the DSCR, the better. DSCR is measured off of kind of a 1-to-1 ratio. 1.0 DSCR means the rental income covers the mortgage payment. So there's other things that we offer, like an interest only feature. If there is an interest only feature, you can actually utilize the interest only payment to qualify, which can impact the DSCR as well. So get the most out of that as you can. Using 120% of the market rents in certain cases. We're just trying to do everything we can to get that DSCR ratio as high as we can from an eligibility and a pricing standpoint. I mentioned it previously, but using the primary wage earners FICO to qualify, that's a huge thing that can really impact. We just sent something around that was a 4.5 point difference by utilizing the primary guarantor's FICO in this loan. So it can really be impactful. And that really is true of all of our products. Even a bank statement loan, you could use a primary wage earner. If it's, husband and wife and they're 50-50 owners, you just take the higher score there. So that can really help you. And then choosing that Investor Premier product. So that's kind of our carve out niche that we have from our standard Investor Connect. If you can meet this kind of bucket of criteria, it's a tighter box for sure, but because of that, you're going to get some significant pricing benefits from it. And all of that can be navigated via the LoanNEX system. So it'll prompt you for these things. It'll show you the differences. The Q&A will tell you, are we using interest only? If so, make sure that we're utilizing the interest only payment there. So it really helps navigate you through that. And then I just wanted to do a quick highlight on some of the changes to DSCR that are going to be coming. I mentioned it before, we're increasing our LTV, CLTV, we're increasing our loan amounts, we're increasing the eligibility for first-time home buyers within our DSCR product. And we are also offering an unlimited cash out. We cap currently at 1.5 million, but we're taking that to the max. So you can actually get potentially 3 million out in cash out. So just some of the changes happening with DSCR. Again, all things that, are prompted by the LoanNEX system to help you understand what they are, help you understand the impact they have on your eligibility and pricing.
That's great. And that's more evidence what we talked about earlier with the existing programs. Paul, you want to talk about Logan's programs?
Yeah, absolutely. We've been fortunate from an execution standpoint to just roll out a new series of products known as the Open Road series. And Open Road has been able to increase the loan to values in a couple of areas that we mentioned before. We just took our loan to value on bank statement and full doc to 90 LTV. I haven't seen that since before COVID. We've also been able to roll out a condo-tel offering, which again is serving those areas. I mean, it's everywhere from vacation rental areas to urban areas, and many people are finding the condo-tel to be quite useful. We've expanded our short-term rental qualifying as well to give a little bit more lift off to people who are in that market overall. But our products themselves, we have the standard things that everyone kind of knows about, but within our products, it's really the niches within those products that really help us stand out in this somewhat crowded field today. So, our bank statement loans, there's no overlay for NSFs. We can take an expense factor down to 10% for qualifying of our using business bank statements. When we look at asset qual, this has been really ringing a bell with a lot of people recently. There's no haircut on the eligible assets that are being used for income. So 100% value of all assets being used in that qualifier. And there's a lot of people who have accumulated a lot of wealth and interest in growing their investments in the last several years. So that's really starting to be a benefit with some of the boomers and people that are retiring out there looking to use those assets as income across the board. We mentioned the P&L as well. That's just another way of getting people in the door that might have more complicated business structures that are self-employed. And with our P&L, we're not looking at any type of bank statement requirement behind that, right? So we're just looking at unaudited profit and loss for as little as 1 year with a 2-year history of the business there. So, overall, to the points made earlier, just growing the market, driving the awareness. Our business development team has been really materially involved with a lot of our national accounts, particularly strategically looking at how to customize that training even more so. We're hearing more people at conferences say, my guys just don't get this, and we really want more focus on one element or another. A great example of that is the foreign national, which is a true, person buying a second home or investment property here. We're seeing a lot of lift off in that market because we're educating more people on the product and where to find the true foreign national, right? Someone who's coming from outside the U.S. to just live here part-time, remaining back home. Those are the types of things that we're seeing a lot more interest in specific customized training rather than just our Logan way of training as we tend to do. But yeah, that's where we are at this point. We are having a road show in Newport Beach, California next month, August 19th. So hopefully people can join that in person, learn a little bit more of some of the things that Raj mentioned we did in our last one in Dallas.
That's great. And this deck will be distributed to everybody that's registered for the webinar. Everybody's contacts will update Paul's contacts in here and Raj's contacts in here as well. It's all clickable, so you'll be able to access directly to Logan and to SG right out of this deck that we're sending out. And I appreciate you mentioning one of the conferences. We will be out at the Western Secondary as well. Anybody that's interested in learning more about LoanNEX, the LoanNEX service as a retail service within your integrated platform, or even as a standalone supplement so that you can, arm your loan officers to really have, just as Taylor talked about earlier, a good non-agency workflow and queue for how to work through these. But we're really excited to have you both. Thank you both for coming on. A lot of great insights into what's going on in the market and what's going on with you guys. And I want to thank everybody for joining us.